Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing a company that was actually brought up by HB, where he said, could I check out Blackstone BX? Big company and no one is talking about it on YouTube. Maybe interesting for you. So I actually did analyze BlackRock a couple months ago if I'm not mistaken, and never really did Blackstone. So you know what? Let's analyze Blackstone to see what we could learn from this company's fundamentals and maybe whether we want to buy it at this current moment. So with that said, let's get started with this analysis. Now guys, before we actually get started, I would actually just like to point out something very important about Blackstone, and that is that this company really is controversial. I mean, for the past, 2 years, ever since COVID of 2020, we have heard that Blackstone and BlackRock have been buying up houses, and even I have an article right here from Yahoo Finance saying fund giants like Blackstone and Open Door keep gobbling up homes even as mortgage rates rise. Yes, unfortunately, big corporations like Blackstone and BlackRock and Open Door are buying up homes, and people are not liking this. But this is not what we're here to look at. We're here to look at this company's fundamentals to see if maybe we could buy it. So coming over here to the company's dividend summary. This company does pay out a dividend yield, guys, of around 5.68%, which is huge, honestly, which ends up being $1.32 per share. This actually comes out to be an annual payout in dividends of $4.56. A little bit less than that of BlackRock, but nonetheless, $4.56, it is still very good as a payout for owning this company's shares. Now, what isn't good though is this payout ratio of 85.07%. Obviously, this isn't telling us in regards to the cash flow, so we're going to take a look at this in regards to the cash flow as well. But nonetheless, this is not looking good. I like to buy anything under 60. 85 is definitely above what I would like to buy it at. Now, the 5-year CAGR on this is actually very good at 16.66. Ignore the 666 right there, by the way. That was just coincidence. Just saying. But nonetheless, 5-year CAGR of 16.66, very good, right? Double digits is just amazing to see. But what isn't good, though, is this dividend growth of 2 consecutive years. And if we actually look at the dividend history, we can see that their dividend isn't consistent at all. You can see that they cut it some years and they put it back up higher than before. So this is not something that I like to see when it comes to a company giving out a dividend, especially if I'm looking for a company to subsidize my income in the future. But nonetheless, that doesn't necessarily mean that you may not want to consider buying it for other means. Now, ex-dividend date passed as of April 29th, payout date was May 9th, and they pay their dividends quarterly. Now let's come over here to the spreadsheet. Ticker symbol of BX for Blackstone. Market cap of $112.7 billion. PE, guys, of 12.68. This PE is actually not that bad. I like to buy anything under 20. And seeing that's 12.68 with a current share price of $93, this actually might not be a bad company to buy in accordance to their earnings alone. Does this mean that we automatically buy it? No, we're going to take a look at other fundamentals to see if maybe we can come up with future assumptions as to where this company is going and what price we should be buying today for that future growth. Now, looking at this dividend further, of $4.56 in regards to the current shares outstanding, they pay out, guys, around $3 billion in dividends every single year. Now, if you take a look at their 5-year average free cash flow, well, we can see that they can't necessarily cover this dividend that they currently pay with their 5-year average free cash flow. They're at negative $2 billion. But if we take a look at last year's free cash flow, they could barely subsidize it with around $700 million left. Now, these payout ratios in regards to the 5-year free cash flow and last year's free cash flow end up being around 82.23 for last year's cash flow and a whopping 267.61% in their 5-year average free cash flow payout ratio. So, as it stands, these as well do not necessarily say that they are able to subsidize this dividend at all. Now, guys, let's do some fundamental analysis, starting, of course, with the net income 5 years ago of $1.5 billion to 1 year ago of $5.8 billion. Massive increase of almost 300%. And this is actually very surprising because, well, you can see that from 5 to 2 years ago, they were roughly flat, right? At around like the $1.5 billion mark. 2 years ago, obviously when COVID hit, they did go down to around $1 billion or so. But the big outlier here is 1 year ago, boom, $5.8 billion. Ironically enough, this is when the whole hype of housing started to happen, and that's when we got the controversies of Blackstone and BlackRock buying all these residencies, single-family homes. So not surprising that their net income went up this much during that time. So take that with a grain of salt. The fact that we're seeing this massive jump 1 year ago says it's an outlier, and we can't really trust it for future net incomes. Now let's take a look at the free cash flow, the lifeblood of the company, guys. The most important profit metric, because this is the one that says if the company's even able to operate. Companies use free cash flow to pay out a dividend, buy back shares, pay down their debt, grow the company, and even make acquisitions. So cash flow, guys, is very, very, very important. Now, it's actually really surprising because 5 years ago, they did a negative $1.6 billion. And if you actually take a look at this, this wasn't a case that the capital expenditures exceeded the cash from operations. It was actually that their cash from operations actually went negative to negative $1.6 billion. So what happened that year? I have no idea as to why they did cash from operations negative, but nonetheless, it is something to take a look at. This is something I suggest you guys do more research on if you are interested to buy this company. So the fact that this here is an outlier, you know, once we get one more year worth of data, this will essentially push everything one to the left, and it will essentially seem like there wasn't a negative free cash flow 5 years ago. But nonetheless, negative $1.6 billion to 1 year ago, guys, of almost $4 billion, increase of 338%, with a 5-year average of around $1.2 billion. Now, obviously, the big elephant here in the room is that 5 years ago, as I said, but also look at this. 4 years ago, they did go positive, but only 27.3 million. And on top of that, guys, the 3 and 2 year ago number were roughly the same, right? But then, because last year during the whole fiasco when it came to the housing market and all that stuff, which is still going on, let's face it, a lot less, but it's still going on, they shot up all the way to 3.9, essentially $4 billion. So this is all over the place, and this actually makes it very, very difficult to come up with future free cash flow. And now looking at the last profit metric, the revenue, we see something very similar to that of the net income 5 years ago of almost $7 billion to 1 year ago of $22.2 billion. Increase of almost 220%. Same exact thing as the net income, guys. Pretty much flat from 5 to 2 years ago, and then 1 year ago, boom, shot up to $22.2 billion. So again, makes it very, very difficult to come up with future revenues as well, because I don't know if they'll be able to continue this trend of, you know, 22, 25, 30 billion dollars into the future, right? As it stands though, these profit metrics are kind of, I guess, 50-50. Mainly because of this outlier that we see the 1 year ago. Makes it very, very difficult, as I said, to come up with future projections. But regardless, let's take a look at some balance sheet numbers. Total assets minus the total liabilities. Can this company survive an economic recession by liquidating their assets? Meaning, do their assets cover their debts, which is part of their liabilities? Well, according to this, guys, currently they are able to at around $22.2 billion. And to the credit as well, they have been in the positive within the past 5 years. Similar to what we saw with the profit metrics, right? 5 years ago to 2 years ago, roughly flat at around like the $14 billion mark. Yet 1 year ago, boom, it shot back up to around $21.7 billion. And even today, they were still able to increase that a little bit more to around $22 billion. Average total assets is around $34.5 billion. Average liabilities around $17.6 billion. And doing this difference, we get around $17 billion. Now, assets minus liabilities is a great metric to see if a company's assets can cover their liabilities. But companies use their cash flow to pay down their liabilities, right? So let's take a look at this, right? Let's see if within the past 5 years, their cash flow has exceeded their liabilities. And we do this by taking the cash flow and then subtract the liabilities from the cash flow. Essentially, if they have more cash flow than liabilities, then they can cover their debts with just their cash flow alone. Now, as you can see right here, this isn't necessarily the case. However, what is really good is that within the past 5 years, they have been able to essentially get this number closer and closer to zero, meaning that they have been able to pay down their liabilities or their cash flow has essentially shot up. That's pretty much what this is telling you. Even though we are still in the negatives by around $15.6 billion, the fact that they're getting closer and closer to zero is a really good positive thing. And then if we take the average cash flow and subtract the average liabilities, we get around $15.7 billion in the red. Now looking at the shares outstanding, the metric that I always dread to look at because it could be a toss-up. This is again very, very important because the issuing of shares for whatever reason, right, it is still diluting you as the investor. Some cases I understand as to why they are diluting you. For example, IPOs, if they issue shares, they're obviously issuing it to get that cash back, to reinvest back in themselves. Great, that's what they should do, but that does not take away from the fact that they are still diluting you. So as it comes over here to Blackstone, well, kind of surprising, honestly. 5 years ago of 669 million shares to today of 707.2 million shares. Increase in the 5 year of 5.76%. And from the previous year to the current year, guys, this is looking at 1 year ago of 704.3 million shares to today of 707.2 million shares, increase of 0.41%. So as it stands, guys, this is an increase. It's a little bit above as to what I would consider okay, but nonetheless, it is still an increase nonetheless. They are diluting you as the investor, and it's something I have to take into account when coming up with future assumptions. And lastly, looking at the cash and equivalents, they currently have, guys, $3.9 billion in cash and equivalents with an average cash of around $2.4 billion. Alright guys, now it's time to make some assumptions. Low, median, high, as always, doing 3 different factors: revenue growth, predicted share buyback, and of course, the required rate of return, which I like to keep flat at 10% just to match the overall S&P 500, which it usually does around 10%, right? So doing the revenue growth first, guys, let's take a look at Blackstone's revenue growth year over year. We see that it's around 50%, and the revenue growth forward is 31.24%. So that gives us a pretty good understanding as to what analysts think is going into, but my job as an investor is to be conservative when it comes to these numbers and assume worst case scenario, right? We just had, guys, an inflation number of 9.1%. That's going to make things rise a significant amount, and eventually the system will crack, and I think the housing market will eventually not crash like in 2008, but it should dip a little bit, and that's going to come down a lot on companies that are buying a lot of houses like Blackstone is, right? I need to take that into account. So for the revenue growth, let's say a 20% revenue growth for the low assumption, 23% for the median assumption, and 26% for the highest assumption. Now for the predicted share buyback, we see that they have been issuing shares, so we need to take this into account. Now for the low assumption, guys, I'm going to say that they're going to issue shares even more into the future at around negative 6%, right? For the median assumption, let's say around negative 4%, and for the highest assumption, negative 2%. Obviously, the negative just means that they're issuing. The positive means that they're buying back. That's what the negative and positive means when it comes to the predicted share buyback. Now that we have these numbers, we can see the target share price, guys, not adjusting for debt, assuming these assumptions, right? We get $76.83 for the low assumption. For the median assumption, it is $85.89. And for the highest assumption, it is $95.86. Very, very interesting, right? That's actually pretty close to the current share price of $93. Now, adjusting for debt, the way we do this is we take a look at the cash equivalents, take a look at the net debt, and then if they have more debt than cash, then obviously this number comes down. And if they have more cash than debt, then this number comes up. So doing this, you can see that the target share price comes down by around $3 or so to $73.85 for the low assumption, $82.86 for the median assumption, and $92.77 for the highest assumption. Now, I also like to add a margin of safety on top of this target share price, adjusting for debt, of 5, 10, and 50%. And in doing so, this puts me between the marks of around $62.78 all the way up to $70.16 for the low assumption, $70.43 to $78.72 for the median assumption, and $78.86 to $88.13 for the highest assumption. Guys, the current share price is $93, right? So this might actually not be a pretty bad buy right now, right? We're essentially between my median and high assumptions. And again, all of these numbers, all of these values that we're getting for the target share prices is based off of my assumptions. If you do not agree with them, let's say that you believe that BlackRock might actually grow at what the revenue growth forward said, which is at around like 30%, right? Well, right then and there, if you think that in the future they're going to issue shares but at negative 2% and they're going to grow their revenue at 30%, well, this is an all-out buy, even with the margins of safety of 5% and even 10%, right? And we're fairly close to the margin of safety of 15% as well. So that's just an example as to why every investment is the present value of all future cash flow, and you should make your own assumptions. This is why I have this calculator available for free. Anybody can have it. If you guys don't want to use it, fine, no problem. I have it available though, just because I want you guys to have a process in order to invest, and not just to invest because of news or hype or any of that stuff. Look at past performances and then make assumptions into the future based off of those past performances. That's just the way that I like to invest, and I promote it because it's been going very good. If you guys have seen my other videos where I show my stock investment portfolio. So that's just the reason why I like to give out this calculator, as well as a book value ratio calculator and a re-evaluation calculator, which, by the way, I do plan on using very, very soon. There's a company that has earnings coming out, I believe next 2 weeks, I think so, that is a REIT company, so be on the lookout for that one. And guys, as well as a dividend tracking sheet. All of this, guys, I'm giving out for free. All I'm asking for in return is like, subscribe, comment. It really does help here. Thank you for the 730 subscribers. Dear God, I can't believe it. Every single time I see that number, I just cannot believe it. Thank you all so much. It motivates me to keep going. It motivates me to give you guys these calculators. Thank you so much for the comments. And if you guys have any further companies that you would like me to analyze, please leave it in the comment section below. Now let's actually take a look at these dividends because, well, if you're like me, I like to buy a company not solely for the dividend, but mainly for that dividend, right? I want to be able to retire with a dividend income. So that's just my strategy. But let's actually take a look at this company in regards to its dividend to see if it's any good to invest at it right now. So taking the average US income, $68,703. Bringing this to the monthly, we get $5,725. If we were to buy 1 month's income at this current share price, we would get, guys, 61.56 shares. And at the current annual dividends per share, look at this. We get $280.72 annually, $70.18 quarterly, and monthly of $23.39. I'm always saying, guys, anything above $200 for $5,725, I consider pretty good, right? And even look at this as well, guys. If we were to put in $2,000 instead of $5,000, well, this would be quarterly $24.52. That's fairly close to having $100 annually. That is amazing. For $2,000, you're getting $100 extra in your income. That's actually very good. So as it stands when it comes to a dividend, only a dividend, right? Not taking into account the payout ratio or anything like that, this is looking fairly good. But you have to take also into account the other stuff that I have said in regards to this dividend, the fact that the payout ratio is very high. But nonetheless, $280 is looking very good. All in all, guys, I get that this company is very controversial, but we're here to make money, right? We're here to look at companies based on their fundamentals and then make assumptions as to whether or not we should buy them today. And according to this, well, it just depends, right? It really just depends. Their fundamentals are pretty much good, but that outlier is really killing me. The shares outstanding is going up, unfortunately, but based on the assumptions that we made, well, it looks like it is a pretty good buy right now. So take that with a grain of salt. It really just depends. None of this is financial advice. Obviously, if you guys want to buy it, so be it. If you guys hate this company because they're buying back homes, and that's a big problem for you, then by all means don't do it, right? And that's really just depending up to you. But that pretty much does it for this video. Like if you like, comment, subscribe. Really does help with the algorithm on YouTube. As I said, you guys can follow me on my YouTube sites. Link in the description below. So with that said, peace out. Be on the lookout for the next stock analysis video.